If you or somebody you know are thinking about making the important decision of purchasing a home, there may be some reluctance to start the process due to the increasing mortgage interest rates. But if you wait too long for those interest rates to drop back to the 3% range, you could be waiting for something that won't happen in your lifetime. And there's the dilemma. As the riddle goes, what always comes but never arrives? And that's tomorrow. You see, we all have been there by saying, I can get to it today, I'll look into it tomorrow, but of course tomorrow turns into next week, next month, next year, and before you know it, it's never going to happen. So if you're contemplating getting a mortgage and buying a home, you may not want to wait.
Yeah, homebuyers seem extremely sensitive to the topic because, well, a higher interest rate means a higher monthly mortgage payment, which that compounded with the rising cost of living expenses due to inflation means more uncomfortable household budgets as more and more Americans struggle to make ends meet. Last week, Yahoo Finance reported that Goldman Sachs, who are a huge multinational investment bank and financial service company, changed its forecast on mortgage rates. In January, the firm's housing economists predicted mortgage rates would land about 6.5% to end the year. But now they're calling an audible, and they're changing their opinion and believe that rates will continue to run high through the end of the year, and they've revised their rates to say that at the end of this year, interest rates will be at 7.1%, and at the end of next year, 2024, interest rates will be 6.8% at the end of the year. So, and that was according to Roger Ashworth, the managing director at Goldman Sachs.
I like his name, Ashworth. It's pretty good. Anyway, Goldman's forecast is a response to the Federal Reserve indicating last month that it won't be cutting rates anytime soon. In fact, the benchmark interest rate will likely be higher for longer, and another potential interest rate hike in store this year as the Fed continues to fret about the inflation. Fixed rate mortgages are tied to the 10-year Treasury yield, which has been surging for weeks and got an extra boost following the most recent jobs data. Yields, which has been on the rise as investors increasingly take the Federal Reserve at its word. Goldman Sachs revised their Treasury yield forecast and expects the 10-year Treasury yield to stand at 4.3% for both this year and next, higher than the prior forecast of 3.9% and 3.75% respectively.
Yeah, trying to understand the way the 10-year Treasury bond impacts your mortgage and how banks get their money to lend to us, the consumers, can get a little confusing. I'm going to try to summarize it a little bit here. Your bank is required to they require us to keep a minimum balance on our checking account every night. And it's similarly the same for the banks. The Federal Reserve requires the banks to keep a minimum balance on theirs. And banks are required to keep or maintain 10% cash on hand as collateral in order to borrow money from the feds through its discount window. The banks will borrow money at a discounted rate, and in turn, they mark the interest rate up, and then they give it to us, the consumers. And they make the difference. That's the profits for them. Banks may not need to borrow money from a discount window for every mortgage that they provide to a customer, but when they do, the 10% collateral rule is in effect.
For collateral, banks traditionally exchange U.S. Treasury notes and commercial loans, but also could use assets such as residential mortgages and mortgage-backed securities. Institutions also have access to 3 different types of lending programs: primary, secondary, and seasonal credit. But that's a topic for another discussion. We can really get in the weeds on that. The big question is when will I see my mortgage rates back to the 3% level? And unfortunately, that's not going to happen anytime soon, and maybe not even in your lifetime. A good indicator of predicting where mortgage rates are going is by looking at the history, knowing where the interest rates are going by where they've been. And if you average interest rates over the time since 1975, that's kind of the date when it looks like they first started tracking the interest rates. The average rate would be around the 7% range. That's similar to where it's at, right now.
Yeah, and even though interest rates may seem high at 7% to a lot of people, it could get a lot worse. In 1981, the average 30-year mortgage rate hit 16.63%, and it only came down just a slight bit to 16.04% in 1982. I know my parents bought their house in '87 and had a 12% interest rate. But you know, the matter of fact of it all is from 1979 till 1990, the average interest rate was in double digits, meaning 10 or above. And interest rates didn't hit the 3% mark until 2012, and the average interest rate in 2012 was 3.66%. So from the time mortgage rate data was being tracked, 1975, until 2012, it took 37 years. 37 years. And at that point in 2012, we reached what many would consider historically low interest rates. And what they really meant was there's a very good possibility we may never see those rates again in our lifetime.
Yeah, that's why I was saying, like, you might never see it again because it took 37 years to hit under 4%. I mean, it took 37 years. You could have had your mortgage paid off by now.
Yes.
These are 30-year mortgages, right? So, but why did it happen, right? So it's because back in 2008, the Great Recession began. The housing market crashed along with the economy. Many homeowners ended up being underwater on their house. They owed more than what the house was worth or what it could sell for. So to help stimulate the economy, the Fed lowered its interest rates by using fiscal policies, one being quantitative easing, or QE for short. QE helped increase the supply of money to lend to customers for mortgages by essentially printing money out of thin air to purchase its own government bonds and mortgage-backed securities to lower interest rates for banks near zero. You see the air quotes there because I don't trust what the government's doing. Anyway, in 2013, the Fed said it would scale back the amount of bonds they would buy, and ultimately the average mortgage interest rates fluctuate a little bit between, the threes and the fours between the years of 2010 to 2020, but remain relatively reasonable for most. And by the way, if you haven't already, please subscribe to our channel. Turn on that bell notification if you receive any, so you can receive updates for when we post a video. And if you like this video, give us a thumbs up. If you hate it, give us a thumbs down. Let us know what you think in the comments below. I'd love to read every one of them. So,
yeah. But it wasn't until 2020 and the COVID-19 pandemic, which brought the world and most economies to a standstill. But to prevent further disaster, the Feds cut the federal funds rate down to a 0.05%, causing other short-term and long-term rates to drop as well. And by the end of 21, the average interest rate was around 2.96%. So if you bought in 21 at the end, you did great. But it wasn't until the last year in 2022 when the Feds began to raise interest rates again to reduce the amount of money in the economy. This was a result not only from QE policies, but it was also due to all the stimulus checks that a lot of people got during the pandemic. Remember all that free money that was going around that people were receiving? That money does not come without consequences. Whenever there's too much money in the economy, the purchasing power of the money decreases, and that's what we're seeing, and that's the reason why the interest rates or the inflation got so high.
Yeah, I mean, everything, you've probably already seen it in your own budgets at the time of recording right now. So I'm sure you're going to McDonald's, it's really expensive. You're going to the grocery store, it's very expensive. Gas is not what it used to be. I mean, it's just everything is high inflationary because there's too much money in the economy. So they have to raise interest rates to burn that money. Basically, the government's taking a profit from those interest rate payments and going towards the ledger to pay off some of that money that was printed. But it shouldn't matter, right? All the Fed has to do is print more money and buy its own bonds to lower interest rates again, right? Maybe not. At least maybe not in the foreseeable future as geopolitics continue to play an issue in this. So see, some speculate the reason why the U.S. can confidently just keep printing money to pay its own debts is because the U.S. dollar is the world reserve currency. Believe it or not, there's other companies and countries, obviously outside the U.S., in order for them to transact on a global level and to purchase things, they got to buy U.S. dollars first and then use those dollars to purchase things like oil, right? But see, the thing is, there's a lot of countries out there, they're tired of this shit. They're tired of buying U.S. dollars to purchase other shit. They want to use their own money or some other type of currency. So, as of right now, there's a bunch of countries standing up to the U.S. dollar being the global reserve currency. Matter of fact, China and 20 other countries, China and other countries have all agreed to stop using the U.S. dollar for global transactions this year. What this will mean for the dollar in the future, who knows? It remains to be seen. It may not be a question of when the Fed can print more money, but if they could do it on the level in which they have been.
Yeah, I think more importantly, what it does mean for people thinking about buying a home is that the predictions for 2024 should see a decline in the mortgage interest rates. But if conglomerates like Goldman and Sachs, backtrack on their early predictions, if they backtracked in January and they put out this new article last week, they can backtrack on the new article last week as well. I think it's a wait and see approach that we have to take to see what the situation is. But if you listen to Federal Chairman Jerome Powell, who said back in July that it's also going to take the economy slowing down and the labor markets to weaken for inflation to credibly return to the U.S. Central Bank's 2% interest rate or inflation target. So in other words, for interest rates to lower, the economy needs to slow down, meaning companies need to start making less profit, reduce the amount of people they hire, and even start laying people off, which this is not something that I don't think anyone wants to see. I know I don't. But in this situation, it seems that there is, a decision, a trade-off here. Either we have a robust U.S. economy, which will mean higher interest rates, or a struggling U.S. economy, which will result in lower interest rates.
So I guess if someone is waiting to buy a home when the interest rates are back to the threes, it means that essentially what you're doing is you're waiting for another crisis to happen. And I don't know if that's something you want to wish for, because that could mean something else entirely. It could mean massive layoffs. People are losing their jobs. So you can't even plan to buy a home if you lose your job. I just don't know if that's something you want to necessarily wait for. But if a home buyer is considering buying a home, you shouldn't wait and try to lock in their interest rate now, because here's the thing. I mean, interest rates are going to continue to fluctuate. And if Powell is right, Jerome Powell, the Fed chairman, that he sees interest rates rise in the foreseeable future, 7 might not look so bad. Because I remember having to talk with other buyers, a little while ago when the interest rates were in the 5s. Like, we're going to wait till the interest rates go down. Well, it's 7% going towards 8. What are you going to do now? Oh, we're just going to rent. Well, rent's going to go up too, because, why wouldn't you raise the rent? Because people are demanding rent if they're not going to buy, right? So, sounds like if they're planning on buying a home in the future, then they should probably, put it on a timeline if they want to do it, right? So here's the thing. Want to buy a house? Okay, great. Interest rates are fine. What does the saying usually say with buying house and interest rates?
Yeah, buy the house, not the interest rate.
Right. So because you could always refinance?
Yeah, exactly.
Yeah. So someone's if you're planning on buying a house, put a timeline on it, right? Put a timeline, say, this time next year I want to be a homeowner, because goals without timelines are dreams, right?
Yeah, and I've even broken down some numbers here just to give you perspective. If you're right now, you're sitting there, you're like, hey, I'm contemplating whether or not I should buy at 7% or just rent for another year and see if the rates come down. Well, I've went ahead and done the math for you here. So if you're looking to buy a house, $250,000, and I'm only using principal and interest because taxes are different in every state and your homeowner's insurance is based off of you and your history, so you can't control that. But for the principal and interest, $250,000 house at 7%, your monthly principal and interest payment is $1,663. If the interest rates were 3%, which is where everybody wants them to go back to, your payment would be $1,054. The difference is $609. Now, if you're looking to buy a house at $250,000, I doubt that you're going to be looking to rent a place for $609, because that's where you would need to be at in order for it to make sense to rent for another year and hope the interest rates go back down to 3%. If you're looking at a $300,000 house At 7%, it's $19.95. That's your monthly payment. At 3%, it's $12.65. So the difference, $730. Now, I've gone through here and I've done this at $350, $500, $750, and even $1 million. And at a whopping $1 million, at a 7% interest rate, your monthly principal and interest payment would be $6,653. And if it was 3%, it would be $4,216 for a difference of $2,437. And if you're looking to buy $1 million house, I doubt you're looking to rent somewhere for $2,437. This doesn't make sense. So don't wait. Don't spend money on rent paying someone else's mortgage when you can pay your own. It's just that simple.
All right. Well, that concludes.
All right. So, yeah, let's wrap it up here. And thanks so much for watching. Please subscribe. Give us a like. Please leave comments below. Let us know how we're doing. We post a new podcast every Friday. And stay tuned for the next episode.
All right. Thanks, guys. See you later.